In today's video, we're going to take you over some of the biggest crashes in history. You're probably witnessing your first market crash. I've been around for so long, I've seen so many, I'm going to try and take you through them. So first of all, just looking at this chart I found for you here, crashes from 1896 to 2016. Look, they've listed exactly the reasons on the chart. You can see there are many ups, many downs. There's lots and lots of pullbacks in markets. It's natural. It's just some of them end up being a bit bigger than others. But what you'll be amazed to know is that there's actually a lot of commonality between them. So what sort of factors should we be looking out for in crashes? A lot of them are caused literally by shocks, things they call black swans, grey swans, things that you weren't expecting. So growth shocks, and that can be from over-exuberance, just someone making the wrong decision, putting rates up at the wrong time, or just a crazy war that started over nothing. So geopolitics, wars, shocks, and the one thing that's common amongst all those is it creates what they call contagion, which is where everybody panics at the same time and it catches on from one market to another. Look out for things like exuberance, people buying things crazily. You've had art sales paying $6 million plus for a banana stuck to a wall. It's crazy. Big run-ups in valuations, just like you're seeing at the moment with the Mag 7. And that brings money in. IPO surges, raising money, everybody borrowing to invest. Look out for statistics that are talking about that. High concentrations, just like the Mag 7 is 38% of the S&P. Crazy stuff. Narrow breadth has taken the market up. The other 493 have gone nowhere. So it's over leverage, crazy stuff. Meme stocks, we saw the Robin Hood and the GameStop, all that sort of stuff. People buying on margin, those figures are through the roof, which is why when we get big sell-off days, people are having to sell because they can't afford to keep the margin being paid to keep the position open. A lot of these things appear because of poor regulation. Nobody was really looking out in the GFC for the subprime stuff. Nobody was regulating what the banks were putting into those products. We'll talk about that later. Sudden growth slumps, as I said. Inverted yield curves. You'll see the short end of the yield curve, the 3-month money, anticipating that rates probably have to go up. Things are getting a little bit crazy. And the longer, the ones that are supposed to show you what the inflation's doing, 10-year plus, 30 years, those yields will be lower. So it'll be sloping from left to right downwards. That's normally a sign things aren't good and that there's potentially a recession ahead. So what happens during a crash? Well, it's bad outcomes, isn't it? You get bad debts, people can't pay it, companies go bankrupt. What look like easy credit lines for investment disappear. Earnings go down. We're seeing a little bit of that at the moment, post the tariffs coming in. Once things go wrong, once people start pulling the money out, you get runs on banks or capital flight. That's money leaving countries. At the moment, they're talking about the dollar being under a small run globally. People are selling the dollar to get away from the US assets. This creates often, and we'll see on a number of occasions, a sell everything moment. No, people don't care what the price is, just get me out. As a result, a thing to look out for is the financial sector. XLF is the ETF in the States. Put that into trading view, keep an eye on what's happening there. If that breaks down, normally means that there's some bad debts underneath and you need to be careful. An easy thing to watch is the VIX. That's the implied vol of the S&P. It's the fear gauge. The higher that goes, the more likely the market is to move around a lot. Divide it by 16. We always tell you to do that. That tells you how many percent per day it'll move up or down on average. Something you'll have noticed in trading of late, days being long, days of rally go on for longer than the sells. But those rallies run out of steam quite quickly. And when they go down a long way very quickly. Trade the long rallies and sell if you can during the momentum down days. When is it going to be over? Normally when there's a V-shape in the market and there'll be a momentum divergence. So look for RSIs and MACD to be slightly higher when there's a market bounce. This is when we'll see the market turning round, when you've got a lower low and a momentum that hasn't gone to a new low. Things are suddenly turning, more buyers are appearing. And remember, at the end of the day, market crashes so far always seem to recover, even the Great Depression that we'll look at in a moment. It's all about the length of the recession generally. In the last few years, they've been a bit shorter. COVID didn't last that long. 21, 22 didn't last that long. And hopefully right now, Trump will start thinking about saying some positives and we can get the market going. So what kind of things will you hear the commentary talk about? Swimming naked. What do you look like when you're in a recession and there's over leverage and exuberance? When the tide comes in, you'll see who's not got any swimming trunks on, i.e. the people who can't afford to keep that trade going. Too big to fail. That was used a lot in the GFC, but they let Lehman Brothers go, didn't they? And that was probably a black grey swan. Nobody expected them to let one of the biggest banks in the world go. This time it's different. A lot of books from around that time always sort of reference that. Often it's slightly different. History rhymes, doesn't repeat, but as we'll see, there's lots of commonality amongst crashes. And they listen out for whatever it takes moments. That is normally when we hit the bottom. That's happened in 2 or 3 of these big crash moments. Once the regulators decide to bail it out, put the liquidity in, that's when we're going to get the bounce, the bailout rally. So let's jump in very quickly to what they looked like in the past. The Great Depression was a daddy boy, peak to trough, down 89%, lasted between 1929 and 32. Now, a lot of these, we've had a lot of exuberance going in. So the Dow had actually doubled in the previous year. We had the roaring 20s post-World War I. Everybody was super happy. And then in 2 days, we had a 23% pullback. That started to make everyone panic. It also made people on margin. They suddenly had to put up more money for their position. They didn't have it. They'd have to sell something else perhaps, or they'd have to go to a bank and pull their money out, or they'd just try and sell and walk away. So you've got everybody doing this at the same time, margin calls, and eventually the banks started collapsing. And as a little rhyme to today, there's a thing called the Smoot-Hawley Tariffs Act. And that was 2 governors that were trying to put on tariffs to make protectionism of United States businesses protected. They didn't need it. America had current accounts. They had surpluses mainly overall with the rest of the world. And that is it at the moment. America has goods deficits, but in terms of services, they have money coming in net wasn't required. And that was often cited as being the thing that made the whole thing worse. Could be repeated today. The 1970s, another big one. The Dow lost 52% between 72 and 4. The UK market, people don't really talk about it, was even bigger, down 73%. They had a few other reasons. And Hong Kong, that fell from 1,800 to 300, so 83%. So some massive moves in the 70s. What happened? Well, everything was okay, but confidence suddenly disappeared. There were political scandals, the Vietnam War. But America had crucially come off the gold standard, the Bretton Woods Agreement, and that meant that they were trying to devalue the dollar. Well, lots of things were pegged to the dollar, so it started creating angst in those regions. We had an oil crisis on top of it, which started adding to the supply side of the economy, prices going up. Just like we've seen in the last few years, once that happens, you get inflation in the system. They have to put rates up. The UK had a housing crisis. There were rents were out of control. People couldn't afford to either pay the rent or buy their houses. GDP went from 5.1% to suddenly negative. But once it was all over, the UK index doubled in 3 months. The US, though, went into a decade of stagflation. So you've got to look for your regions and you've got to look for the reasons whether you should escape or not. The next real big one after that was Black Monday. You've probably heard of that. October the 19th, 1987. Again, off the back of the post-70s stagflation recovery in America, the market had gone up 4 times in 5 years and 44% in the 7 months of 1987 leading into it. But again, a shock to the system. US suddenly had a trade deficit, which meant that there was falling confidence in the dollar. They had to try and put interest rates up. The yields in the market went up because people were selling bonds. Everybody wants to get out of the United States. There's a crucial factor here. When you're invested in an area, you don't want the asset going down at the same time as the currency. So we've got it at the moment. The dollar's going down. People want to sell American assets. It's a double whammy. So at that time, the Treasury Secretary, James Baker, I think it was, devalued threats. He threatened to get them out of this mess by devaluing the dollar. Not a good thing. But then there was also the setup of the markets. This was the start of a digital, electronic world, electronic trading soon to come. And the settlement systems weren't in line. So you might be selling something where you'd only get your money in 4 days, but you needed to pay for something in 2 days. So this was causing mega stresses to the system. Portfolio insurance had just been introduced. This was derivatives, the brand new world. All the Greeks that you hear, the gammas and the deltas. So people were long assets, but they were also hedging it and selling other instruments, and that was causing extra problems when the markets were moving a lot. A lot of these positions were designed for markets that didn't move a lot, and we suddenly had big sell-offs coming at the same time. Unlike today, there were no circuit breakers. Whatever happened, people want to sell, it just kept going down and down, margin calls increasing, and this created sell moments everywhere. This was the first time you could see markets all around the world on electronic devices. So people were staying up all night watching what was going on in Tokyo in the Asian session to get ready to trade again in the London or American session the next day. Globalization actually caused contagion, the word we used earlier. One market catching on to another, the fear spreading, losses mounting. This one is the first time it ended with what they called the Fed put, where they came in, loosened conditions, made things a lot easier, and that's what the markets are looking out for right now. West Germany and Japan agreed with that, and they equally rescued Europe and the Asian markets by making funds readily available to keep people afloat. New Zealand, no one ever talks about this, but they refused to loosen conditions. They thought that was irresponsible, and they ended up having a lost decade, losing 60%. So it's often important that you do global coordinated responses, and that's something that comes up much later. After that, Another 10 years, the Asian currency crisis and LTCM. LTCM was a hedge fund designed to try and capture differences between futures markets and the spot markets, or in this case, between regional bonds. They were playing in Russia. They basically bought the peripheral assets, the emerging market, effectively, assets, and shorted the safety of the US assets to pay for it. I'll explain now, that was probably the wrong place for anybody to be in. So we had an Asian crisis, currency crisis in 1907. There'd been a lot of speculation, particularly in places like Thailand and Hong Kong. People were putting money in. The exchange rate was pegged to the dollar. It wasn't moving anywhere, so you couldn't lose really on the exchange rate. And you were making out like a bandit on some really speculative trades. All of a sudden, a bit of slowdown came to the region. A few investments went wrong. People wanted to get their money out. And all of a sudden, so much money wanted to come out that the peg got broken. The government decided to remove that. So panic started to spread across the region, and then everybody wanted to get their money out at the same time. And the dollar was in a strong period anyway. That it was the start of the internet, the World Wide Web, etc. So suddenly, all the American companies were attracting lots of inflow. So the dollar was strong just as these currencies were weak at the same time. So that actually caused an Asian growth hit. So one of these growth supply shocks we talked about at the start, and that caused problems in Russia. So the oil price, because the growth was suddenly hit, Russia relied on oil revenues to keep things going, so the ruble crashed. So then they didn't have enough money to pay the Russian debt, the same Russian debt that LTCM had bought. So they were now holding bonds that were falling through the floor, making losses. And where do you go when you want to hide? Traditionally, you go into dollar or dollar assets, and that is the US Treasury bonds, the 10 years, etc. So suddenly there was a massive demand on the other side as well. So they had the thing they'd sold going up and the thing they'd bought going through the floor. So they got hit massively. Panic selling everywhere. It was a currency crisis in Asia, spread to the rest of the globe. The S&P fell 19% in 45 days, and the Fed did a putt again. They bailed out the system to $3.5 billion just to cover the derivative exposures of LTCM. Something that we talked about earlier, over exuberance, overvaluation. The forward PE on the S&P was at 25 during that, all this money rushing in 1995, etc. And it had run up 50% in 18 months. So lots and lots of money chasing the same assets. The Dotcom Bubble, the real big crash that many of you may have been around to see, or your parents would have been. What actually happened, the Nasdaq fell 78% by 2002, so within around 18 months. And on April the 14th, they had a week-on-week fall of 25%. So what happened? That run-up we talked about, 1995 to 2000, was 800% on the Nasdaq composite, and that's where all the tech stocks were originally. They're in the 100 now. PE on the Nasdaq stocks had reached 200, and that was mainly because there was no earnings. It was a speculative tech bubble. If you mentioned as a company that you had an internet or a website, then you'd automatically double the share price, if not more. It was going up factors of 2s, 4s, 6s. That created more and more money surging in over the old speculative bubble. There were cheap interest rates around. They decided to cut capital gains tax for even more investment. So they were pouring oil on troubled waters, just fanning the flames of the fire, as it were. And this mantra, I saw this mantra at UBS. We were the most profitable consumer-facing business on the equity side, but we decided that growth over profits, just growing the revenue regardless of whether it was profitable trades. This is what was happening. If you couldn't show that you were growing revenue but not necessarily making any money, then people would come up with the phrase, get big or get lost. Just a speculative mania. This is what you see. Came to Super Bowl in 2000. 12 of the 61 adverts were bought by .com companies that I've just said, most of them didn't have any money to pay for it necessarily. Again, we get an inverted yield curve, 3-month money to 3 years, all trading higher than the longer ones, 30-year. What do we know about inverted yield curves? They normally lead to a recession. So everything was coming here, bubbles, you've got worries in the bond market. The Fed decided to put rates up right after the horse had already bolted in 97, 98. So right on the top of everything going wrong, they decided to put rates up. So this, again, was a time for everybody to get out. They were panicking that would force a recession. And right in the middle of it, Japan announced a recession. So we've got Global Contagion, we've got Global Connection, recession in one of the most important areas, with the Fed already tightening conditions, not loosening them. And on top of that, you had scandals from Enron and WorldCom, where a lot of the actors from the LTCM had actually ended up creating crazy structures. And there was a lawsuit on Microsoft for anti-competitive behaviour. That ring a bell, it seems to happen all the time, and Europe at the moment, right in the middle of that. Well, that hit Microsoft 15%, right in the middle of the big sell-off. So lots of things you've seen before there. The big one that I remember trading the most, 2008-9, the GFC. I was in the previous last two, but this is the ones where we were really active. The S&P lost 50% over 17 months. Again, this was a housing bubble this time. Excessive speculation, deregulation in the markets to kickstart everything after the 2002 lows became quite lax. Nobody really knew what the banks were up to. They'd had lots of things repealed so that they could actually put on speculative investments without anyone really keep reining it in. So there was a lack of regulation. They started to package up subprime loans. So people who couldn't really afford to pay their mortgage were suddenly attached to A-grade credit loans. We've all seen the infamous crash and the people who bet against that. The housing bubble obviously burst, and then it was a global contagion. They actually thought the system could be brought down by the exposures. Bear Stearns went bust. Northern Rock in the UK, they had their mortgage book taken away. Lehman Brothers, too big to fail. They were so exposed to this, and they decided to actually let something go to get the permission from the people and the government to actually do the bailouts that came. The system on the edge of failure. Things to look out for is when it's too big to fail, as I said before, when it's time for the backstop, the lender of last resort. And this happened with the American Recovery and Reinvestment Act, $787 billion to backstop everything. We decided at the time to buy all the European banks on the back of this. It looked like it literally was a one-way bet, and it turned out to be that way for 6 months. The COVID flash crash, this starts to bring in other elements, a little bit like the 70s. You get a growth shock because we're suddenly all locked down, we can't go anywhere, international travel crashes, oil prices crash, you've got a supply shock, things aren't being made. So even if you come out of it, the inventories are going to be so low, and that's kind of what's happened to create the inflation that we're still at the wrong end of. So it literally was a supply shock to the system. Coordinated easing again. Now a lot of people are blaming the current over-exuberance on the extra money that was thrown in. It probably didn't need to be as much. We just needed to know that rates would be cut, etc. And the Fed are still dealing with that extra QE that they threw in. Something that you'd expect to get sorted because you had real-world people trying to deal with that problem. It wasn't necessarily a financial market thing. We got the vaccines, 33 days between February 19th and March 23rd. FTSE down 33%, MSCI World down 34%. But it was very much one of the quicker recoveries of all these crashes. Leading on to that, we've had the Ukraine war. Russian invasion just added to that whole supply constraint. Breadbasket of the world, Ukraine. So that's obviously affecting the food side. We've got the energy crisis. Europe had tied themselves to Russian energy and oil in terms of manning powering the factories, etc., etc. So the COVID response had caused inflation and asset bubbles, and you've got the Ukraine on top. Interest rate hikes obviously being thrown in. Everyone started panicking, and we still haven't seen it yet, but we were told there was a guaranteed recession because of this, and we had the old favourite, the bond market, the inverted yield curve. And we've had that until recent times when the Fed started to move the interest rates last year. S&P fell 28%, late 21 to late 22 really. How did that stop? Inflation peaked in October. So that cathartic sell-off happened on the last bit of data. We had a V-shaped recovery on the day, and we haven't really looked back since. And in July, Apple and Alphabet had started to say that they were seeing real boom time earnings from AI. So that was the start of the recovery and the rally that we would see into the Trump. So this is the final one. Just renew over to see if you can recognize even more repetition of what we've seen before. NASDAQ 100, we've had a bear market of 20%. The S&P has been down there as well. And now, what sort of things happen on the way up to that? We've had the narrow leadership, Mag 7 stocks, 38% of the S&P. AI bubble, some people call it. The other 493 not really going anywhere apart from on risk-off periods when you see a little bit of reversal. Within that, high PEs into 2024. We actually last year saw earnings going up, and right up until Q1 recently, people were anticipating $300 of earnings for 2025, and they were willing to pay up to 24 times for it. So an S&P year-end 25 anticipated to be 7,000. Since then, we've suddenly got this tariff shock. So an external tariff shock just hitting global growth, just as things are potentially rolling. China's in deflation. They've got a big economic crisis, etc. Growth slowing down, and Trump has managed to make people think that 25 earnings are going to be 250. And people now, because they're panicking, don't want to pay those kind of 24 multiples. They're paying 20 at best. So, 250 times 20 gets you 5,000 for the S&P by the year end. So you're seeing a complete reversal of what was an over-exuberance suddenly into a panic the other way. De-dollarization since the Russian-Ukrainian war, they seized their assets. That made The BRICS countries, you've seen that, the Brazil, Russia, India, China, South Africa, and there's been threats of this kind of gold currency to replace the dollar. People are trying to get out of their dollar exposures. The Bank of International Settlements and Basel III have made gold an equivalent to the dollar as a reserve asset. So, funnily enough, everyone's been buying gold again. And if you're buying gold, you are selling the dollar. Just adds to the whole pressure of getting out of dollar-denominated assets into something physical in this case. So, have we got a political mistake from Trump? That'll come out in the end. Surrounded still by geopolitics. Ukraine's not over. We've got Israel and other Middle East, Iranian conflicts. And we've got nothing but soft survey data, consumer confidence crisis, just as you've got potential growth slowdown. Then that's potentially all leads into bad loans, people losing their jobs, etc., etc. So all these fears start to manifest and pile upon each other. What are the things are going on that we've seen before? High debts. Low-income people got high debts relative to their low incomes. High investment from retail in general, so we've got record low cash rates. That is normally a sign that you're in a bubble. Leveraged instruments everywhere, 3 and 5 times Nvidia plays, Tesla plays, ETFs. You know, we're not just buying the market, we're buying it leveraged to the eyeballs, which also means margin calls when it goes wrong. We saw the day a couple of weeks ago where everything went down, including gold. People having to sell gold that was their winner to pay for everything else. So, you know, we've got earnings per share going down, multiples in reverse, all these crazy stock bets, but there's no Fed put. The Fed have refused to bail us out. In all the other crashes, we knew once the Fed started coming in to help us bail out, make looser conditions, then it was game on. So we're looking out for that, we're listening out for that. At the moment, we've got switching out of US assets. We've got people still selling to buy into other regions. Europe's seeing inflows, America's seeing sellers of bonds, of equities, and like I said, they're seeing people buy commodities to just get out of the dollar. So where that will end, who knows? But we are starting to see some volatility now. People literally rallied when there was a delay to tariffs. People want it to rally, but at the moment, nothing is fixed. You've got to play those headlines. So what should you do? Well, we've spoken about this many a time on the videos. Dollar cost averaging. You shouldn't necessarily, if you're investing for long term, be putting all your eggs into one basket at the same time. Keep investing. You're taking advantage of the market coming off. Don't panic, don't sell everything. You're going to be selling at the bottom most likely. Most of these, as you saw on that first chart I put up, most of these sell-offs recover. It might take a decade sometimes for the prices to recover, but in general terms, the bottom takes place in up to 6 months, some of them shorter, in which case you're selling something that's bouncing back up. If you need to do something, perhaps diversify into a few things that are safe havens, are what they call consumer staples that do well in defensive times, just to keep yourself invest in the market, but not necessarily panicking out of everything. As I said, things usually bottom after a few months. They will recover eventually. And markets innovate. Don't listen to politicians. At the end of the day, entrepreneurs and the market people will get us out of this. Lots and lots of commonality to the crashes. Look out for things that are just getting overblown. Sometimes you'll see what happens in the markets. You get double tops because people ignore the warning signs. And that's a little bit of what's happened here. At the start of the year, really, all the signs were there that you should be selling off, expecting at least a consolidation, but people bought back in to the next rally, and that's where the losses that are sat amongst the system are probably the worst. But like I say, don't panic. We're probably closer to the bottom than we were a couple of weeks ago. We've put in lower lows. It's time to get your skills to work and try and find the next rally up. So that was a look at some of the biggest crashes of the last century, really, and I hope you saw the commonality. There's political mistakes, tariffs get in the way, often runs on currencies for unexpected reasons. Just growth suddenly stops. One company might suddenly have a crazy loss that no one expected, and all confidence disappears from what was looking like a one-way bet. If people are over-leveraged, if they've overbought this, then there can be problems. If regulation is poor or markets don't sync, then there can be margin calls that go wrong that cause runs on banks, and the whole system starts being under pressure. Remember, look out for the bailouts. Once the system looks like it might fail, the Fed is normally there as a backstop. It shouldn't be relied upon completely, but just movements in the last few weeks have shown that just as Trump and Besant don't want things to go through the floor, some smoothing words can help. Once the Fed gets in line with that, and the data hopefully is pushing them towards that, then we might see that in the current crisis find a proper bottom. In the meantime, just be careful, because there has been a lot of over-leverage into the stocks that have taken us up in a narrow leadership, the Mag 7, etc. And if the AI boom were to show any cracks in terms of earnings, then it would be justified for another pullback. So keep your eyes and ear to the ground and look out for some of the signals and signposts that we've shown you throughout this video.